Joining us now on the markets and prospects for earnings season, Marta, Norton, Chief Investment Strategist at Empower. Good to see you. Thanks. You're on set with us. You have, I guess, been looking forward to corporate earnings because you think they could be okay and surprise maybe on the upside, although tariff concerns remain. Given the number yesterday that you saw for the CPI, when we got it, it was, to be honest, we were kind of mixed. It didn't look as bad as the worst case scenarios, but there looked like something possibly seeping into the numbers that could be related to tariffs.
Yeah, I think when the numbers first came out and you had the headline number, you had the core number, I think most people breathed a sigh of relief. And it wasn't until you started to distill the underlying dynamics, particularly within goods, that people started to see some sort of tariff impulse, particularly around, things like furniture and the like. And so I think it was a number that maybe had something for everyone in it. If you wanted to say inflation wasn't a big deal, you could say that. If you wanted to say there was a tariff effect, you could see that in the numbers as well.
And it probably didn't get you to totally change what you thought for earnings and for corporations, but you got one eyebrow, or half an eyebrow. Did you cut the estimates on any of the companies you followed based on yesterday?
Well, no, not based on kind of the inflation print yesterday. And I think when we're taking a look at earnings, one of the things that jumps out to me is that the bar has been lowered so aggressively relative to where we were maybe at the start of the year.
For Delta.
That's right. That's right. And just kind of, if you're looking at the S&P 500 as a whole, you're looking at sub 5% earnings growth. That's a hurdle that's not all that difficult to beat if you continue to see some of this AI momentum take effect. And you typically do see that, right? With corporate earnings season, you do see the realized results tend to beat those estimates. So I think that can be kind of a panacea for the market, but that doesn't necessarily mean that there isn't a tariff overhang that I think in the long run is in effect here.
Well, at the beginning of the year, people were worried about valuations. We had, this sell-off into Liberation Day, but now we're all the way back.
Right.
So we got the same basic multiple, but you say now only 5% growth. So earnings have come down a little.
That's
the multiples are the same. So you think we're overvalued?
Yeah, I would argue that we're pretty overvalued. So, the thing with valuation is that when there's just modest deviations from the average, it really doesn't matter in terms of future performance. But when you're at these more extreme levels, and I would argue we're extreme for a whole range of sectors, certainly for technology, but also for areas like industrials, like materials, like financials. It's a lot harder to be excited about forward-looking returns over the next 3 years.
And the stocks that look cheap, you're not really in love with the ones that look cheap.
You know what jumps out if you're looking at cheapness across the sectors in the U.S. is something like healthcare. Healthcare is one of those areas that has been pretty beleaguered from a performance standpoint. And then I think a lot of the concerns both around tariffs and both around kind of Trump administration policy is weighing there.
Event risk is there too. We may hear something today about tariffs on pharmaceuticals.
That's right. That's right. Yeah.
How about small caps? Everybody loved them, and
that's right.
They shouldn't have been loved as much.
That's right. Well, it's hard when you look at small caps not to be caught off guard by the valuations. They're a little bit, cheaper, arguably, than something like healthcare, but they're potentially cheap for a reason. You have concerns around the economy, and also tariffs weigh heavily on small caps, and so I think there's a rationale from a valuation standpoint to have some interest, but you have to have some care too.
But you like, the other thing that maybe hasn't moved is international, and
That's
you like
right.
that more than small caps, and you got the dollar currency headwinds. Tailwinds for international
That's
markets.
right. Yeah. So the dollar, of course, down roughly 10% year to date, and I think what jumps out to me when I look at people's portfolios broadly is there has just been such an emphasis on U.S. assets, whether that's on the fixed income side or the equity side. And that's because we've had this tremendous run over the past decade or so. And so I would argue that this is even structural. Even though we've seen this rally outside the U.S., there's still a rationale to have a bit more of a balance to your portfolio.
So with what the Fed looks at, so you got yesterday wasn't terrible, but it wasn't great. How about the economic backdrop at this point? The labor market's still good. You think that this makes a September cut more likely than a July cut?
Well, I don't think a July cut is in the cards
Not
at
possible.
all at this point. But I would argue that we have to have a little bit of, I guess, hold our convictions loosely when it comes to the timing of the Fed cut. I do think that's where we're headed. But there are some question marks, especially with the latest announcement of tariffs and the desire of Powell to take all the fiscal policy into account. I think they want to be really thoughtful, and avoiding a pivot, I think, is pretty important in policy. So September seems likely, but I still think we need to hold that conviction loosely.